Joining us now is Darryl Cronk, Wells Fargo CIO for Wealth and Investment Management, and Ross Mayfield, Baird Investment Strategy Analyst. Welcome, guys. Darryl, it looks like the market is pricing in the perfect scenario. Softish landing, 70% likelihood of rate cuts in Q4, though. Very little concern about this debt ceiling standoff. That's kind of an oncoming train, but you're not quite so sanguine about it all.
Yeah, I think that's right, John. I mean, when you look at the stock market, it's pricing in, higher highs. So is the volatility market when you check out the VIX or the MOVE index. But the bond market tells a very different story. And I think the data underneath tells a real different story. We all know about how narrow the leadership's been in the tech space, so I won't replay that. But I think when you get under the surface and you look at the more cyclically sensitive areas of the market, so think places like retail, think energy, think manufacturing and industrials, they just haven't participated. In fact, they've been quite weak underneath the surface. And so it tells you that along with leading economic indicators and everything else, that things are still deteriorating as financial conditions and credit conditions tighten at paces we haven't seen in decades.
Okay, so Ross, you're a strategist, so let's talk strategy. What is the kind of risk that investors can still afford to take in this environment, especially when you got a stock like NVIDIA that's more than doubled this year?
Right, and I think that's what you have to weigh, right? I mean, near term, we're trading at the top end of a range. There's an obvious near-term headwind in the form of the debt ceiling. You still have a rolling banking crisis and a Fed that is continuing to talk rates higher in spite of inflation heading in the right direction. So where do you want to be? I think near term, you could position a little more defensively. I think, again, at the top end of a range, a narrow rally, it wouldn't be that crazy to be positioned in something like staples, which still have some pricing power in a difficult environment. But we don't want to be too defensive in the form of shifting asset class allocation altogether. The market has been really, really resilient in the face of all these headwinds. I don't know that the new bull market is right around the corner, but we want to make sure we don't miss the beginning of it because they usually are pretty aggressive when they rip.
Yeah. Darryl, NASDAQ highest since August 2022. The big caps, that mainly tech, that lead the NDX, highest since April of 2020 today. Meantime, another flurry of Fed speak, and it does seem like the message is higher for longer in interest rates. Just a short while ago, you even had Jamie Dimon talking about this at JP Morgan's Investor Day. We're going to get into that a little bit more, but in the meantime, how do you position for that when there does seem to be this mismatch between the bond market, the equity market, and what the Fed is saying?
Yeah, it's a really good point, Morgan. And we still actually have Fed hikes in our forecast for later this year. We don't think they hike here in June. We do think they pause and do this skip that people talk about. But we do think that they're going to have to come back to the table later this year and continue to probably raise rates. So on the bond market side, you've got to barbell your exposure today. We think you've got to be on the short side of the curve, harvest those yields, particularly in the T-bill market where you now have the one-year T-bill is 175 basis points above the 10-year, which is almost unheard of. And then on the long side, you're going to play kind of the economic slowdown, recession, and rates there that are going to give you a decent return. The one interesting thing I'd point out here, Morgan, is if you go back to early February, the last time the market was at these levels, credit spreads are now 100 basis points higher than they were at that time. High yield credit was 385 in early February. Today it's 480 basically. So credit spreads are leaking higher quietly. People aren't paying attention to that. And I think it's a little bit of an ominous sign of where we are in the cycle.
Yeah, that's interesting and certainly one to watch. And we've been talking about it so much and the fact that it hadn't been making those moves, at least until recently. Ross, debt ceiling, this is a drama that is playing out. The market's moving on a daily, hourly basis right now. It's expected to sort of suck all the oxygen out of the room until we get a deal, if we get a deal. You're an investor. How do you position for this, especially when somebody like Roger Altman comes on CNBC earlier today and says, you know what, politicians are probably going to need the market to spasm and spasm hard to be able to say, hey, look, see, we reached a deal because otherwise it's financially going to be terrible for America.
I think there's a lot to that point. We've been saying that for quite a while, that a lot of times policymakers need that equity market volatility or that push from the financial markets to get to the table. We've seen it in short-term treasuries. We've seen the chart of short-term U.S. credit default swaps. But until it's in the equity market, until it's hitting 401ks, I don't think there's the same impetus for policymakers to get to the table and really start working. So in the near term, I mean, we're coming up on that X date that Treasury Secretary Yellen has laid out, but we still have several trading days before then. I would not be surprised to see equity markets start to wobble. I'm actually, quite frankly, surprised that we're trading so high with such a short time until that X date. But I wouldn't be surprised if it gives it that push to get something done, or at least give them the cover to say that they got something done.